let's just get right into it. Have you ever wondered if there's an actual, literal free lunch in the high-stakes world of investing? Like a Wall Street secret that mathematically gives you an edge without you having to resort to just blind, reckless gambling? I know, it sounds like a total myth, right? Something way too good to be true. Well, in today's explainer, we're going to unpack exactly that. And I promise you, by the end of this, you're going to look at your own investments in a completely different light. Welcome to our explainer on modern portfolio theory and asset allocation. We're breaking down the exact high-level academic strategies that institutional investors use and translating them into practical, actionable steps for your own wealth building. No dense jargon, just clear insights to turn your scattered portfolio into a highly efficient financial engine. Section 1. Investing's only free lunch. To really appreciate the solution we're going to talk about, we first have to face the elephant in the room. The absolute biggest problem every investor wrestles with is that constant, agonizing tug-of-war between high returns and brutal market volatility. Just look at this one-year historical data chart from Vanguard. That teal line, that's shares, and the brown line is cash. Look at how violently those shares swing around. I mean, you're down 40% one minute and up nearly 70% the next. Meanwhile, cash is just chilling as a smooth, mostly flat line. This right here, this is the stomach-churning reality of short-term market swings. It is exactly why it's so incredibly tempting to just stuff your money under a mattress and call it a day. But hold on, watch what happens when we zoom out. If we look at that exact same data over a rolling 20-year horizon, the whole story flips. Those previously terrifying jagged shares, they are now absolutely towering over cash, beating it by massive margins. This perfectly captures the golden rule of investing. That long-term reward, that is literally your compensation for enduring the short-term roller coaster. The risk itself is the engine driving your return. So the giant puzzle for all of us is figuring out how to balance perfectly on this risk-to-reward seesaw. Picture a heavy, stable safe on one side. That's your cash and bonds. On the other side, you've got this explosive, highly volatile rocket representing shares. If you lean too hard toward the safe, inflation just silently eats your purchasing power alive. But if you go all in on the rocket, a sudden market crash could wipe out your savings right when you need them most. Section 2. Modern Portfolio Theory Explained. So how do we actually find that perfect balance? Well, the answer lies in a framework created by an economist named Harry Markowitz way back in 1952. Modern portfolio theory, or MPT, is basically a mathematical framework for assembling a portfolio to maximize your expected return for a given level of risk. Simply put, under MPT, you never look at a single stock or bond in isolation. Instead, you're judging it entirely on how it plays with the rest of your portfolio. It's kind of like baking. You don't just eat a spoonful of flour. It's all about how the ingredients combine to make the cake. And this brings us right back to the start of our explainer. That free lunch we were talking about, it's asset diversification. In fact, academics have repeatedly called diversification the only free lunch you will find in the investment game. Why? Because mathematically, when you combine assets that behave differently in different economic conditions, you literally lower your overall risk without tanking your expected returns. It's basically a financial superpower. Think of it like this. If you trip and drop one giant basket holding all your financial eggs, it's game over. You lose everything. But if you strategically spread those eggs out across several different baskets, say some domestic shares, some international equities, maybe a few government bonds, one dropped basket isn't going to ruin you. Since these assets aren't perfectly correlated, meaning they don't all crash for the exact same reasons at the exact same time, putting them together smooths out the bumps in the road over the long haul. Section 3. Mastering asset allocation. Okay, I want you to burn this number into your brain, 93.6%. There was this landmark 1986 study by Brinson, Hood, and Biebauer where they looked at the long-term performance of 91 massive pension funds. And they found that a whopping 93.6% of the variance in a portfolio's return comes down purely to its asset allocation, meaning your high-level mix of stocks, bonds, and cash is practically the whole ballgame. It's not about being a genius stock picker, and it's definitely not about timing the market. It's the broad, kind of boring strategy that actually dictates almost all of your ultimate financial success. Now, when you're actually putting this into practice, you've got two main camps. First, there's strategic allocation. Think of this as the set it and forget it method. You pick a mix based on your personal goals, and you stubbornly stick to it, completely ignoring the short-term noise on the news. The other side is tactical allocation. This is the hands-on approach where investors try to outsmart the market by jumping in and out of different asset classes to catch quick wins. So, which one actually works better for your wealth? We'll take a look at this colorful quilt chart. Every colored square is a different asset class, like emerging markets, domestic property, or fixed interest, ranked from top to bottom by performance each year. Notice how chaotic that is? The colors are just bouncing all over the place. Last year's absolute biggest winner is constantly plunging to become next year's absolute worst loser. Trying to accurately predict which segment is going to pop off next is pretty much impossible. And that is exactly why a disciplined, broadly diversified strategic approach beats trying to tactically outguess the market almost every single time. Section 4. The Boglehead Portfolio Strategy. So how do you actually build this mathematically sound portfolio without a PhD in finance? Enter the Boglehead strategy. This is a wildly popular DIY approach inspired by Jack Bogle, Vanguard's legendary founder. It is all about brutal simplicity and keeping your costs as low as humanly possible. Seriously, it takes literally just 3 broad market index funds to build a globally diversified portfolio. You grab a domestic stock fund, an international stock fund, and a broad bond fund. That is the whole shebang. With just those 3 incredibly cheap funds, you effectively own a tiny slice of the entire global economy. But, and this is key, you can't just buy them and literally forget about them for 30 years. Over time, your stocks might go on a tear and suddenly take up way too much of your portfolio. To keep your risk in check, you have to systematically rebalance. It's exactly like a gardener pruning a really fast-growing plant so it stays healthy. If stocks have a massive bull run, you're suddenly exposed to a ton of unintended risk. So, rebalancing forces you to do something that feels incredibly backwards and, honestly, a little painful. You sell your absolute biggest winners while they're high, and you use that cash to buy the boring lagging assets when they're low. It feels wrong, but it snaps your portfolio right back into its original perfect balance. Section 5. Staying the course. The math behind MPT is flawless. The real wild card here? Human emotion. Vanguard actually laid out 4 foundational principles to keep our own brains from ruining our investments. Number 1, create clear goals. Number 2, keep a balanced mix. Number 3, minimize your investment costs. And number 4, maintain discipline. The deeply empowering thing about this list, these are quite literally the only things you can control. You can't control inflation, you can't control corporate earnings, but you have 100% control over your asset allocation and your own discipline. Because let me tell you, the real-world cost of losing that discipline is devastating. Take a look at this chart mapping the brutal market crash during COVID in early 2020. That top teal line, that represents the investors who just gritted their teeth, ignored the panic, and stuck with a 60-40 balanced portfolio. They eventually wrote it out to a 46% return. Now look at that bottom gold line. Those are the people who lost their nerve, sold everything at the bottom, and ran for the hills into cash. By trying to tactically dodge the drop, they completely locked in their massive losses and totally missed the inevitable rebound. They ended up with less than half the return of the people who just stayed put. Discipline literally pays. Which leaves us with one final, provocative question that I really want you to ask yourself today. Is your current portfolio actually working for you, or is it just exposing you to risk without any real reward? Take a hard look at your own investments through the lens of modern portfolio theory. Are you genuinely diversified across the globe? Are you bleeding money on high management fees? Are you following a proven, boring strategy, or are you just sort of reacting and guessing? The only free lunch on Wall Street is sitting right there for the taking. It's up to you to grab a plate. Thank you so much for joining me for this explainer, and I really hope this knowledge empowers you to take absolute control of your financial future.